Assalamualaikum and good morning everyone. I'm Muhammad with my member Syed Adam, Atika and Awati will present evaluation of financial performance. We from Group 2.
Start with the current ratio of company in Nohino. The current ratio is a financial ratio that measures a company's ability to pay its short-term liabilities using its short-term asset. A higher current ratio indicates a better ability to meet short-term obligations. So for Indohino, the current ratio has fluctuated. It started from 1.9 times in 2021 to 2.12 times in 2022 and then down to 1.8 times in 2023. The decrease in the current ratio from 2022 to 2023 suggests that the company's liquidity position weakened over that period. This could be due to various factors such as decrease in cash reserve, increase in short-term liabilities, or a decrease in the value of current asset like account receivable or inventory. For the industry ratio, it's also varied with a slight increase from 2.19 times in 2021 to 2.36 times in 2022, followed by a decrease to 2.23 times in 2023. On the other hand, the industry's current ratio has remained relatively stable over the same period. It's indicating a consistent ability of industry peers to cover short-term liabilities and a potential challenge for the company to maintain competitiveness in terms of liquidity. Let's move to the next slide, analyzing comparison. For performance, Indonesia current ratio has consistently been lower than the industry average. This indicates that the company has less liquidity compared to the industry peer, which potentially poses risk in meeting short-term obligation. For trend analysis, the company experienced notable decrease in its current ratio from 2022 to 2023, which is suggesting a decline in liquidity over that period. And lastly, the effect. The low current ratio compared to industry average may raise concern about Indonesia financial health and ability. So it's important to implement strategy to strengthen liquidity position, like improving cash flow management, optimize inventory level, and enhance working capital efficiency. Now, the quick ratio for a company in Indonesia. Quick ratio, also known as the asset test ratio, is a financial ratio that measures a company's ability to pay its short-term liabilities using its most liquid assets. For Indonesia, the quick ratio has shown a similar pattern starting at 1.6 times in 2021, increasing to 1.4 times in 2022, and then further decreasing to 1.2 times in 2023. This suggests a reduction in the ability to cover immediate liabilities with its most liquid assets. Besides that, this decline could stem from change in inventory management or account receivable collection. While for industry ratio, they remain stable with a small decrease from 1.6 times in 2021 to 1.4 times in 2022 and slightly increased to 1.9 times in 2023. This highlighting the potential challenge for the company in liquidity management compared to industry peers. In comparison to Indonesia, the industry's quick ratio has been both higher and lower at times, but overall it has shown more stability and resilience. Next is analyzing comparison. For performance, Indonesia quick ratio generally been lower than the industry average over the past 3 years. This indicates that the company may have less immediate liquidity, which could pose risk in meeting short-term obligation without relying on inventory. While for trend analysis, Indonesia quick ratio decreased from 2022 to 2023, which may indicating a decline in immediate liquidity over that period. And lastly, the effect. The lower quick ratio compared to the industry average suggests that Indonesia may face challenge in meeting immediate cash needs or unexpected short-term liabilities. It's important to improve cash flow management, reducing reliance, and ensuring sufficient liquidity to support ongoing operations.
So next, we go through to question 1.2, which is three application liquidity ratio. First is cash flow management. A company with declining liquidity ratio needs to focus on improving cash of management. This could involve the strategies such as optimizing inventory level to reduce excess inventory, improving accounts receivable collection process to shorten the cash conversion cycle, and negotiating favorable payment terms with the suppliers to preserve cash reserve. Next of liquidity implication of liquidity ratio, financial health. Lower liquidity ratio can raise concern about the company financial health and ability to meet short-term obligations. Creditor and investor may perceive the company as riskier, potentially leading to higher borrowing costs of reluctance to invest. Therefore, improving liquidity ratio is crucial for maintaining the company financial stability and credibility in the eyes of stakeholders. Strategic decision making also implication of liquidity ratio. Weak, weak liquidity ratio should prompt management to prioritize action to enhance liquidity. This may include implementing cost-saving measures, divesting non-core assets to generate cash, or refinancing debt to improve debt maturity profiles. Strategic, de- strategic decision regarding capital allocation and investment should be evaluated based on their impact on liquidity and the company's ability to weather economic downturn or unforeseen challenge. By thoughtfully analyzing liquidity ratio and their implication, the company can develop targeted strategies to strengthen its financial position and ensure long-term stability.
So for the next question, analysis of the asset management ratio and subsidiaries. For the first one, inventory turnover ratio. In 2022, the company got 3.50 times. Meanwhile, in 2022, the company got 3.64 times. So the analysis is the inventory turnover ratio in 2023 is lower than 2022, which is not a good sign. Next, the average collection period. In 2023, the company took 51 days to collect debt. Meanwhile, in 2022, the company took 43 days to collect debt. So the analysis is average collection period in 2023 take longer period to collect debt compared to 2022. The next one is non-current asset turnover. In 2023, the company got 1 times. Meanwhile, 2022, the company got 1.31 times. So the analysis is non-current asset turnover ratio in 2023 is lower than 2022 to generate sale. So for the last calculation is total assets turnover. In 2023, the company got 0.57 times. Meanwhile, 2022, the company got 0.67 times. So the analysis is total assets turnover ratio in 2023 is lower than 2022 to generate sales. So the next question is the optimal courses of action for Samsung and the way to improve the performance of Samsung. So the decrease in inventory turnover ratio from 3.64 times in 2022 to 3.50 times in 2023 indicates a slight decline in efficiency in turning inventory into sales. To improve performance, the company could focus on reducing excess inventory. It's one of the way to improve the performance. Next, the increase in the average collection period ratio from 43 days in 2022 to 51 days in 2023 indicates that it took longer time for the company to collect its receivables in 2023. To improve the performance, the company should give early payment discounts. So next, a decrease in the non-current assets turnover ratio could indicate inefficiency in utilizing long-term assets to generate revenue. The company could analyze why this ratio declined and take appropriate actions such as improving assets utilization. It is one of the way to improve the performance. So for the last one, the decrease in the total assets turnover ratio from 0.67 in 2022 to 0.57 in 2023 indicates that the company's efficiency in generating sales from its assets has declined. So one of the way to improve the performance, the company should focus in increase their sales.
So the net significant debt and profitability ratios. Profitability ratios like gross margin gauge how well a company convert revenue into profit. These ratios provide insight into how efficiently a business convert revenue into profit and value for shareholders. They offer insight into cost management and shareholder value, indicating the efficiency of operation. Okay, let's talk about how ratio used by investor and creditor for companies' financial healthy and performance. Okay, the first one is liquidity ratios, such as the current ratio and quick ratio, which assess a company's ability to meet short-term obligation. For the second one is profitability ratios, like return on equity, ROE, and gross margin, which indicate how efficiently a company generates profit from its operations. The third one is debt ratios, such as debt to equity ratio and interest coverage ratio, which measure a company's ability to manage its debt. Okay, so for the last one is efficiency ratios, such as asset turnover and inventory turnover, which evaluate how effectively a company utilizes its asset.